Welcome to the Profit Answer Man, Karl Baker. It's great to have you join us today.
Thank you, Rocky. Nice to see you. It's been nice to visit with you a little before and looking forward to this.
As am I. Can you share a little bit about yourself and your business?
Sure. Myself, a little bit of my background, which is important to understand how I got here. I'm a licensed CPA, have been for 30 years, 30 plus years. And I'm also blonde and it took me 25 years to realize that I didn't want to be in public accounting. So it took me a little while to figure that out. About 7 years ago, I left public accounting because I really wanted to. The way I said it then, I went back to my roots. I want to help people. I want to be a little more forward thinking in the work that I do. And not at all to denigrate public accounting, but there's a certain look back component and compliance oriented um, note component of being in public accounting. So I wanted to do more consultative value added work. So I started a business doing CFO consulting work, accounting consulting, those sort of things, and have been doing that for a while. But even as I did that, after being in the corporate setting for a long time, I realized, gee, I'm not going to. I'm able to earn a living. I jokingly said that um, my mission statement when you start your business is don't go bankrupt. And I quickly learned I can replace my earnings, and that helped me. And then I just started thinking, what are other things could I do? What do I really want to do? I want to be in finance. I want to be in financial services, and maybe a little less into the debits and credits of accounting. So I also learned about commercial real estate finance advisory work. So long story short, I've been doing that for about 4 years, helping clients advance their cause and looking for financings. That's what I've been doing for about 4 years.
By the way, how is the commercial real estate space? Because I guess offices aren't doing well, but um, other types of I know in our area, warehousing and all of that is booming as always. So I guess it depends what kind of commercial real estate it is.
Yeah, it certainly does. And I guess my answer would be that if you can find a good deal, a win is always a win. And certainly if you can find a deal I'm assuming you're referring indirectly to the interest rate environment. And if you can find a deal that works in today's interest rate environments, then it's going to work eventually and permanently, more than likely, if it's really contingent upon cash flows. So, certainly we're doing a lot in development. We're doing a lot in residential investment property financing. I raise awareness with clients that the win, when you purchase a property, the win is in the property acquisition. And maybe you have to evaluate your cash flows a little differently than you did 2 years ago, but eventually rates will go down. I think that the market is cyclical, and there will be a time when rates will go down and you'll have the property. And that's the way I see it.
And I'm a big fan that a property must cash flow on the purchase. If you
Mm-hmm.
can't cash flow on the purchase, there's a good chance at some point you're going to get yourself in trouble. Um, and that's all. And it's not hard to figure that out.
Absolutely. It's true. And it is definitely harder now than it was 2 years ago, for sure. But there are some diamonds in the rough. And probably it's a truth that the cash flow standards are a little different now. And there are certainly a lot of people that also say because of that, we're not going to change our standards, which is fine, and we're just not going to buy any properties right now. Okay, that's fine, but certainly there are deals to be done, deals to be made, and people's causes to be advanced in that way.
Businesses always thrive. It's just a question
Hmm.
of which one and
Yes.
which area. You just have to learn to pivot. right? And that's a constant. I think that's the one thing that is always changing. You know, I always say it's kind of like a roller coaster ride, and you've got to learn to ride the ups and downs and figure out how to make your changes. And what I really like, and we're gonna kind of start to touch on that, is you should be able to predict that. Like you should know what's coming before it happens
Hmm.
if you've got big or good business systems in place to give you that warning sign that, hey, something's going to happen. And then the second part of it is to have enough cash to get yourself through the dip. And if you can do that, then you can pivot and you can survive.
Yeah, absolutely. One of the things that you touched on there is deals can be found in different times of the market, depending on the industry you're in or whatever. So, in the real estate space, what's one of the big things? The shortfall in residential housing. So, one of the things that's coming my way a lot these days is construction development of multifamily housing or neighborhoods. And those projects are helping to relieve the pressures of shortfalls. We're working on deals in Florida that will provide very good quality housing in that area. That's just an example, but the deals are still there, and it just depends on how you want to your ability to navigate through them, find them, and make them successful.
So let's kind of chat about when
Yeah.
you're doing your CFO services. A big part of
Mm-hmm.
that is mastering the art of cash flow management. How do
Mm-hmm.
we master cash flow management?
Well, my comment on that would be one, having good data. And I talk about this from my own experience and from what I have seen clients when I come in to work with a client. What have they been doing, and what do they need to be doing differently to understand? The overarching comment that I have when I come in to work with a client is they haven't been managing their data effectively. One, their accounting systems might be less than awesome. And so they don't know what they have or don't have. They think their future cash flows are better than they really are going to be. If their accounts receivable in their accounting systems is not accurately reported, then their future cash flows are not going to be what they think they're going to be. So just having good accounting systems to give them the data they need. Two, there's not a lot of good forecasting. And that's kind of a fancy word, but it really doesn't need to be fancy. It doesn't need to be overcomplicated, depending on your business type. But doing something to, in a simple way, um, understand what are your future cash flows and what are they going to be, what are the problems, when are the problems going to hit, and what are you going to do about that, and are you prepared for it? Is everything going to be a crisis week to week, or are you going to manage that with quality systems and quality planning?
And like you said, this is not as complicated as people think.
Mm-hmm.
I've got quite a few clients actually who have long cycles between when the sale is made and then
Mm-hmm.
how the cash comes in and when the cash comes in. And
Mm-hmm.
so we can generally look out 6 to 8 months and say, okay, based on where we're at today, here's what your cash looks like every month for the next 6 months compared to what we've already achieved so far this year. We are at 80% to goal at the moment, even though it's the early part of the year.
Mm-hmm.
But you can't stop because not only do we need to finish this year and get that 20%, but you've also got to focus on next year and building out the sales today or the leads today that convert to the sales tomorrow. that convert to the cash flow 6 months from then. And
Yeah. Pipeline.
pipeline, it sounds difficult, but honestly, I find unless they've got, and most small businesses don't have tons and tons of transactions, um, you can predict a good amount of this. And if you update it every single month, and it literally, for most of my clients, I don't think it takes more than 15 minutes a month. Once we set up their system,
Mm-hmm.
they can just go, oh, thumbs up, things are good, my cash flow's looking good. Or they can start to go, wait a minute, we've got a problem. Maybe it's a delivery problem. Hey, I'm noticing all these deliveries are supposed to happen at the same time. A, do I have the capacity to make that happen?
Mm-hmm.
B, what does that do to resource management? Because we're like, wait, do you want to pay all these people overtime for June? Or do you want to slow deliveries down so that they have something to do in July? Well, you can make that prediction, right? Or is August so busy that maybe we start moving people up to July or the production up? But again, once you can see it laid out, it becomes easy to go, oh, let's just do this.
Well, that's the expertise of running your business, right? It's running a business is more than just knowing the ins and outs of your widget or your product. And I, use that just to oversimplify what it is you're selling, but it's more than just that. It's also knowing how to most effectively and cost effectively get that product to market time and time again. And when I think when we talk to business owners, when people like us talk to business owners can start to shut down when they start hearing fancy words like KPI and dashboards and forecasting, whereas it's really just a byproduct of understanding your business and the processes and aligning all of that to make it an effective delivery of service in the right way. And it can be simple, but you and I both know that there's a lot of challenge out there with businesses, and that's how we can help people.
I was having a conversation with a business owner this past weekend. He's got a nice 7-figure business, and basically what he said is, I'm really good at what I do, which is the technical part of the business. He
Mm-hmm.
goes, but when it comes to looking at the numbers, my eyes glaze over. It's not like I know how to do this. I never
Mm-hmm.
realized I had to figure out the business of business. And it wasn't their thing. And there's nothing, you know what? There's nothing wrong with that because I have no idea how he does the technical part of his business.
Right.
So I shouldn't be doing that.
I keep, as we're having this very conversation, I'm thinking back to a client that I was working with about 5 years ago, and we were in a room, and I was giving a report of the problems that I've seen in their books and their processes, and what it means, and what we're going to do about it, and what they thought the results of their business was versus what the actual results were. And I'm talking to this big room, and I glance over at the CEO, and she's sitting there just going this. In video, I was shaking my head and just sort of sighing. And I stopped and I said, What did I say?" And she goes, "We've just never had this. This is so beneficial to us. We've just never had somebody that helps us understand the numbers and understand what it is that we do, or what our results are, and provide the data so that we can make decisions." So it was very gratifying to know that I can help them. But the answers were all within their stuff, within their data. I just sort of brought it to the surface.
And they are. And literally, I think in a nutshell, that's what we do. We help
Mm-hmm.
them see what's going on in their business because once they see, they know what to
Mm-hmm.
do. And
Mm-hmm.
then we can then answer the question, well, if you do this and you buy a piece of equipment, here's what happens. If
Mm-hmm.
you um can cut your costs by this much, here's what happens. If you hire another employee, this is how much more you have to sell. If you raise prices and you lose a couple clients, here's where the break even is, where you can lose clients and make more money if you do it right. And it's just answering those questions, creating those models, and laying it out for them so they can decide how best to do it.
And the complexity of the problems and the complexity of the business will drive how complex your reporting and those models need to be. They can be very simple. It could be as simple as using some of the tools in QuickBooks, but it could also be as simple as a spreadsheet. That's just a weekly simple spreadsheet. It could be that simple.
Yeah, spreadsheets are simple to you and me.
Fair enough. See, I just went into that, right? But you're right.
Well, I've had 40 years of experience with them, so I guess that gives me something. So at the end of the day, this is about cash flow management. Sometimes we need to borrow money. And I think a
Mm-hmm.
lot of business owners struggle with this part of it. They don't know how to ask for money. And again, they don't understand the language of bankers and what bankers are looking at. They're going, hey, my business is growing and I keep growing and I keep making more money. Surely they will give me money, but not necessarily. So you've got the 4 C's of lending. Let's
Uh-huh.
talk about those.
So, quick story related to that. And I told you a little bit about my thoughts on lending before the show. Um, what I didn't tell you is that I've always had this entrepreneurial notion in my head. I wanted to be an entrepreneur, wanted to be on my own. And about going on 20 years ago now, I was 12 years into a public accounting career, was not trained on underwriting, wasn't trained at that time on how bankers think. I love the way you teed that up. But I wanted to own my own business. I wanted to own either a Christian bookstore, a coffee shop. I'm kind of a coffee snob. A sporting goods store, or a men's clothing store, all inventory related, retail related, manage your inventory, sell, have people walk in. It just sounds fun. To this day, it still sounds like a cool thing for me. But I didn't know how to get money, and I wasn't sure I was willing to mortgage my whole life to get this started. I thought that's what banks were there for. So I called banks and I said, I'm thinking about starting this business. I'm a borrower. You're a banker. That's what you do. Can I get an SBA loan? And I talked to a few of them, but one in particular literally audibly laughed out loud at me and said, you have no chance of getting a loan. No chance. After a few details here and there, you're not going to get a loan. So you're going to need to figure out how to do it on your own. And the story, the reason I say all that is to say that you have to understand how bankers think, like you said, and you have to understand that you have to borrow from a position of strength, not weakness. In that case, 20 years ago, I was borrowing from a position of weakness. I need money. You have money. Give it to me, and I'll promise I'll do good with it. Well, that's just not the way bankers think. Bankers are going to lease money to you. They're not going to take on your business risk. They're going to lease money in a particular situation. And the way they do it is they evaluate your scenario using the 4 C's. And every lender in America articulates it a different way, and they have a different number, but they all talk in some version of a number of C's. Those 4 C's are collateral, cash flow, credit, and what I call capacity of borrower, which covers a few things. It covers the borrower's character, it covers their cash reserves, it covers their experience. But every deal, particularly in a business lending deal, every deal is going to be evaluated, and there needs to be some strength. And they may be weighted, but there needs to be some strength in those 4 C's. And that's important.
So I'm guessing if they don't have good books, the banker A doesn't look well at their capacity to be able to be lendable, doesn't really know their cash flow. And so you've got two strikes against you because you can't tell a good story to the bank.
And that's a situation where you have two strikes against you, and you're not going to get another ball thrown at you. You're not going to get another pitch because that credibility is not there. I've had bankers say their books are not good, and it's going to be difficult to it's going to be difficult to convince me if you come back, or if that borrower comes back with a new story. It's going to be difficult to convince me that they've really changed because their books are not good. What's different this time? So absolutely.
You know, one of the things that reminds me, and it's surprising, if you have an outside bookkeeping firm,
Hmm.
that gives you a higher level of trust because they know somebody is essentially double checking everything.
Absolutely, and that's the case in a lot of things, right? If you have some sort of third party assistance helping you, that adds some credibility. The purpose of a financial statement audit is to add credibility to your numbers. Not that you have to have that in every situation, but it's that same principle that third party review adds strength to the data.
And I think the worst time to go to the bank is when you have no cash or cash flow because that's a strikeout.
Well, yeah. Again, I tell people you have to borrow from a position of strength, not weakness. And just, it sounds kind of crass, but, and I just got off the phone with somebody in the last hour before our recording where we were talking about that. If you're looking for a loan, you can't be dead broke and expect the lender to cover you and um, to there's a phrase I'm looking for, but to help you get out of your hole. That's not their job. Their job is to help you have the capital you need to run a thriving business. And certainly there's going to be a review of other components. But if there's no cash flow, that was actually the scenario. It was a restaurant with no cash flow, no credit score, no real collateral, and no personal wealth. So there were four strikes in a three strike at bat.
The other thing that you do is because banks are very risk adverse, let's face it, that's what they are. But
Mm-hmm.
businesses still need to borrow money, and there are alternative sources of money or people who look at business owners differently, depending on the particular situation, or they're
Mm-hmm.
more familiar with certain types of industry. And so they know how to better read the tea leaves than a banker might. So can you
Mm-hmm.
talk a little bit about that?
Yeah, in business lending, let's just contrast a typical a typical business that comes to a bank. What is it? How is it that a bank will give let's call it a line of credit or a term loan? They're going to typically collateralize, quote, the assets of the business, the balance sheet, all of the cash, the future receivables, but they will collateralize all of the assets of the business. If those assets, and then that's number one. Number two, they'll also look at the credit worthiness of the borrower. So they're going to look at a global review of the borrower. And that will be important to them as well, because if the business happens to fail, all lenders are asking the overarching question: if I give you money, how do I get it back? So if the business happens to fail, are you as a borrower credit worthy and have other means to pay them back if it's not from the business or the assets or otherwise? So it's a two-part underwriting review, the assets of the business and the assets of the borrower. If you don't have that, then you're more than likely going to strike out at the bank because of this comprehensive review. There are other lenders across America that until you sort of get into this, you don't know about it. But there are other lenders, business lenders, real estate lenders that are not banks. They are investment backed, institutional backed. In many ways, they've compiled their capital, and they are filling a niche for those borrowers that have some credit worthiness. Maybe it's a little more narrow than the way banks look at it, but they have some credit worthiness and they're filling that niche. So, for example, and I'll stop talking here in a second, but for example, a business owner may not have a super strong balance sheet, or maybe their own credit score is not great. Well, they may have a hard time getting a loan at a bank because that banker wants collateral. However, they may have a fantastic book of customers, and they may be able to obtain financing from the credit worthiness, the strength of their customer base, using some revenue backed financing that is based on that. And you might have a bad credit score, but the credit worthiness is coming from their customer base. So there's just different ways to find the strength in a scenario, and lenders have figured out how to do that.
They have. They aren't subject to all the rules and they can move a little quicker. That's how they build their business. Again, there's always
Mm-hmm.
opportunities out there for business. You got to figure out your niche. And this is just kind of another niche that's out there. I just tell people to be careful. Those of you who know Mike McAllowitz's story knows that they came for the keys to the house and to his car. And be careful what you're doing. Make sure that you truly have the capacity, and it's proven. Uh, Sometimes people will lend you money even when you're not a good risk because they don't always know better, right? And so make sure you do what's right.
Absolutely, and I'm by no means saying that debt is always the right answer. And it is a truth that there are some lenders, and I don't want to work with them, but there are some lenders that are kind of hoping. They won't say it out loud, but it comes out at the end. They're kind of hoping for failure because then they can foreclose on the collateral and make some money that way. And they don't really care. They're not taking your business risk. Um, but a lot of lenders are not wanting to take your business risk, but they see the risk and they see it as their job to help you not make a bad decision. And I've had lenders tell me that it's my job to prevent a borrower from making a bad decision. And those are the good lenders because they're not just trying to make money before you fail. They're trying to help you and maybe steer you in a slightly different direction. My story 20 years ago, somebody could have given me money and I would have possibly failed, and somebody would have made some money on it, but they would have not done me a good service. And it was the right thing for me to hear, for me to hear them say no, because what they were really saying is, we don't really think you're ready to run a business yet. And at that time they were right. And they protected me in that way. Didn't feel good, but it strengthened me and I learned a lot from it.
Sometimes we need that strengthening. Doesn't always feel good in the moment. So, how do you help business owners with getting capital?
Well, I first listen, want to understand what their scenario is. I want to understand what they're looking for. I want to understand their goals and objectives. I'm not the one that is, going to put them in a situation where they're going to eventually fail. There are lending products out there that I'm not a fan of. I don't even market them, and if they need those kinds of funds, and I'm won't talk about those specifically, but it's just not something I'm going to do. I could personally make a lot of money that way. It's just it's not the kind of sort of bottom dwelling lending that I want to do. I want to be the one that's helping people make good decisions and advance their cause right. So I want to listen to that, and then I listen with an understanding of what the lending products are. And I when you go to a bank, the banks have great good intentions for you. They want to help you, but they're not actually representing you. They are representing the bank, and they will try to see what they can do to help you within the barriers and the limits of their products that they offer. I am a financing advisor, and I will help somebody and I will represent them, and I'm going to find a funding path. And I will understand, okay, is this a SBA scenario? Is this a commercial real estate scenario? Is this a supply chain financing scenario, a factoring scenario? And we will, and anybody like me will find the right solution that gives them the capital they need for the right set of terms, et cetera. It doesn't always mean that it's exactly what a borrower wants, and I think that's important to understand. But it's what they are going to get for their scenario to help them advance their cause.
And that's good. And there are a lot of people out there. There is predatory lending in business, just
Yes.
like there is on the personal finance side.
Yep.
You've got to understand what you're getting involved with. You've got to read the note to understand what it says, because people might tell you one thing. The paperwork doesn't always match what you are told. The paperwork trumps everything. So make
It will be
sure
the
you're
authoritative guide.
actually reading your paperwork. And the other thing is match your financing. And what I mean by match your financing is don't buy a truck that lasts 5 years with a 30-year loan. And don't buy a building that lasts 30 years with a 5-year loan, right? You got to match the right kind of lending to the right type of whatever the asset is so that it is appropriately used. And the one thing we tell everyone is we try to never borrow money for overhead. In other words, your daily operations. If you're borrowing money to run your daily operations, that almost is just, a flag or a red flag to say you're in significant trouble. Your business needs to change because it can't afford to run the way you're running it.
A couple things there relating to that. Number one, I had a thought, and I hope I can retrieve that thought. But the second thing is, it is true. You don't want to be borrowing to meet your basic payroll per se. Sometimes that happens, and there's funding there, but that's not the ideal solution. The only other thing I would say, though, is there. I think there is. There can be wise use of financing in the supply chain. If you're needing to purchase materials that you're going to obtain, that you're going to eventually process and sell, you're not going to be collecting those sale the revenues for quite a while potentially, and yet you've got to pay your people, you've got to pay your vendors, and the strongest business owners are going to do that through some very cheap line of credit financing or other sort of resources if they have those strong balance sheets. Without that, and without any financing, they're going to 100% rely on profits, accumulated and undistributed profits, to fund those early components, which can be difficult. So there's a place for financing in that regard, and I think there's wise use there.
Which takes us back to where we started, which is mastering the cash flow and understanding when money is coming and going so that you know what you need and you can appropriately place your inventory orders, knowing that you can cover it and know what the turnover is, and then making sure you price it to cover your cost of borrowing as well, because hey, you got to pay for that too. If people would like to learn more about you, the funding sources you have, and so forth, what's the best way for them to do that?
Yeah, I'd say look us up on our website. That is infinitycomcapital.com. Infinity, COMM capital.com. Our phone number's on there. An email address is on there, info@infinitycomcapital.com. You can find me on LinkedIn fairly easily. Look up, it's either W. Karl Baker or Karl Baker. But that's pretty easy to find. And those are the easiest ways.
Awesome. And we will make sure to put that into the show notes. Thank
Yeah,
you so much for joining us today.
happy to be here. Thank you, Rocky.
Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.